Welcome back to Talk Tickers. Today we are digging into one of the most interesting earnings reports of the season, Uber's Q4 2025. On paper, it was a phenomenal, record-breaking quarter. So why did the stock get hit so hard?
Yeah, that was the damage on the day of the announcement. The stock dropped over 5% on absolutely massive volume. We're talking over 120 million shares changing hands. That brings us to the core question for this explainer. What caused this major disconnect?
So let's get right into it. We'll look at the headline numbers from the quarter, see how they stacked up against Wall Street's consensus, and then really unpack the guidance, which is where the story gets complicated. From there, we'll dive into the big debate around autonomous vehicles that dominated the call, and we'll wrap it all up with our rating and what to watch for next.
Okay, so at first glance, the story was picture perfect. Uber put up an exceptionally strong quarter, showcasing its massive scale and some really powerful operational leverage. And all that just means they were able to grow their profits at a much faster rate than their revenue, which is exactly what investors want to see.
Now, what's really interesting here is the acceleration you see across the board. Revenue's up 20%, gross bookings, that's the total value of everything on the platform, up 22%, and just look at that adjusted EBITDA, surging 35% year over year. This is a business that is absolutely firing on all cylinders.
And this right here illustrates the engine behind that growth. I'm sure a lot of you watching have used Uber for a ride or to get food delivered. Well, you're part of a massive group. Over 200 million people use the platform every single month. They took 3.75 billion trips last quarter alone, generating a staggering $9.8 billion in free cash flow for the year. That last point is key too. 40% of users are now on multiple products, meaning the platform is just getting stickier. All that sounds great, right? So how did Wall Street react to these numbers? This is where we start to see the first little hint of trouble beneath that stellar surface.
So the top line looked solid, with clean beats on both revenue and gross bookings. The crucial point, however, is the bottom line. Non-GAAP earnings per share, or EPS, came in at 71 cents. That was a miss of 8 cents versus expectations. And for a growth story like Uber, that kind of miss really matters, because it raises questions about whether the company's profitability is scaling as quickly as investors had hoped. That small crack from the EPS miss was just blown wide open by the company's forward guidance. This is really the heart of the issue, as it created two completely different competing stories for investors to try and figure out.
On one hand, you had management hammering home the big picture, their massive scale, this incredible cash generation, and the platform's ecosystem effects. But on the other hand, the market, which is always forward-looking, voted with its wallet on a totally different story. A profit forecast for the next quarter that was lighter than expected, driven by what they see as heavy spending on one major strategic gamble.
So, what was that one key strategic priority causing all the concern? Well, it's autonomous vehicles, or AVs. This topic became the central point of contention, and it completely dominated the analyst Q&A session.
I'm sure many of you watching are wondering exactly how self-driving cars will impact Uber's business. Well, you're not alone. This question from a Bank of America analyst just perfectly captured the market's core anxiety, that a long-term, super expensive push into AVs would just crush margins and profitability in the near term.
Management's response, led by CEO Dara Khosrowshahi, was definitive and really aimed to completely reframe the whole debate. He argued that investors are looking at it all wrong. In his view, AVs aren't a threat to the bottom line, but a multi-trillion-dollar opportunity that will expand the entire market for mobility. And honestly, I was really impressed with how they laid out their strategy here. Their argument has a few different parts. First, they claim their network gives any AV partner a 30% boost in utilization from day one. That's huge. Second, they're insulating their core profit centers, pointing out that 75% of their U.S. profits come from smaller markets where AVs won't be a factor for years. And finally, they aren't trying to build the cars themselves. They're partnering with companies like NVIDIA to create a data ecosystem that helps everyone, with Uber at the very center.
So let's pull all this together. We've got a monster quarter clouded by concerns over future spending. What's our call on the stock now?
We are rating the stock market perform. The underlying business is a cash-generating machine, and that provides a solid floor under the stock price. However, the deep uncertainty around the cost, the timeline, and the ultimate profitability of this big AV pivot is a significant overhang. We think that will likely cap the stock's performance until management can provide more concrete proof points.
And before we go, just a quick reminder that this analysis is for informational purposes only. This is not financial advice. Please be sure to do your own research before making any investment decisions.